We've had more than one reference today to the vignette with which Adam Smith famously began The Wealth of Nations, the story of his visit to a pin factory and how he discovered that 10 people working together could produce many more pins than they could have on their own. Except it's not true. Adam Smith, despite the claims, had never been to a pin factory. He and Adam Ferguson, his colleague in the Scottish Enlightenment, fell out over the publication of The Wealth of Nations, and apparently the pin factory was a particular point of contention, because Ferguson claimed that Smith had plagiarized the story of the pin factory from a lecture which Ferguson had given some years earlier. Ferguson, however, had never visited a pin factory either. Both of them had taken the story from Diderot's French Encyclopedia. And of course, Diderot had never been to a pin factory either. It's possible that somebody had been to a pin factory. Normandy was then the center of European pin manufacture, and Diderot had a contribution from someone in Normandy who had given this account of a pin factory, and crucially provided a drawing of a pin factory from which was based the story that Ferguson and Smith told of the 10 men making more pins together than any of them could have done individually. So the story is not true. It's no more genuine than that portrait of the great man. But it doesn't matter, just as it doesn't matter whether that actually looks like Adam Smith or not. It doesn't matter because the story isn't about making pins. People do not turn to The Wealth of Nations or even Diderot's Encyclopedia to learn how to make pins. It is a story about the division of labor, and the facts of pin manufacture are neither here nor there in relation to that. That's one of the themes I want to develop this afternoon, that economic models are not about telling us true stories, giving us true accounts about how the world works. They're ways of conveying insight into how the world works, and we need many models and many approaches. If practical economist needs a toolkit of models and learns to apply particular models to particular problems. Soon after I was at Oxford first, and before I knew London well, some friends invited me to dinner at their house in London in Hyde Park Gardens. And in these days, before Google Maps, etc., I asked them, as one does in London, what's the nearest tube station? And they told me Lancaster Gate. Well, on the evening in question, I took the train from Oxford to Paddington. When I got to Paddington, I looked at the tube map and worked out how you went to Lancaster Gate. And if you look at the tube map, if we can find the tube map.
Yes. There it is.
If you look at the tube map, you can see how you go from Paddington to Lancaster Gate. You go 2 stops on the Circle line to Notting Hill Gate, change trains and go 2 stops to Lancaster Gate. However, if you look on the surface map, yes, you can see Paddington, Lancaster Gate, Notting Hill Gate. What you do, in fact, is you go about 2 miles more or less due west to Notting Hill Gate, change trains and go 2 miles more or less due east to Lancaster Gate. It takes about 5 minutes to walk directly from Paddington to Lancaster Gate. You might conclude from that the tube map is a bad map. Actually, the tube map, the London tube map, is widely regarded as an inspired piece of graphic design. It was created in the 1930s by an electrical engineer called Harry Beck. As I say, it's been an excellent piece of design which has been imitated by subway and other systems all around the world. It's a very good map. It has helped millions of people find their way about London. It is just a rather bad map for my particular problem. And a famous phrase coined by a Polish philosopher whose name I confess I'm never able to pronounce, called Bzybzybski. The map is not the territory. There's a story which has been told many times of the competition to create the best map of the world. Most recently, there's a fine exposition by the Argentinian novelist Jean-Louis Borges. And of course, the best possible map of the world is a map which exactly replicates the world, and a map which exactly replicates the world is, of course, entirely useless. The point of a map is that it is a simplification. And to be a useful simplification, it has to be problem-specific. And that's what George Box had in mind when he famously said that all models are wrong, but some models are useful. Now, that observation might raise a couple of questions in your mind. Firstly, wouldn't it be rather useful to have a model, an economic model, that did exactly replicate the world? After all, we can have the world, but we don't have an equivalent. We don't have the equivalent ability to see the economic world as a whole. Well, a model that exactly replicated the economic world might be useful, but the task of actually compiling one is unimaginable. That's not a realistic projection to make. I'm not going to debate the quite difficult question of what sense, if any, physical models can be regarded as true replications of the world. What I'm clear is that no economic model ever could be. And that ought to condition all the way we think about economic models. There are in physics some models that are so useful that you would be crazy to use any other. An engineer, a practical engineer who'd said he didn't much believe in Newton's laws of mechanics is not one we would employ, even if he's right that Newton's laws of mechanics don't apply at very small or very large scales. But that model is so useful that you would be crazy to use any other. But how do you know what model to use on a particular problem? Well, I now know London quite well, and I would not make the mistake which I made many years ago trying to get to Hyde Park Gardens. The difference is one of experience and judgment. And to say that is unfashionable. After all, didn't we learn that the risk models, the highly sophisticated computerized risk models created by professionals in the financial services industry were far better at judging risks taken by banks than the gut instinct of experienced bankers, which people had used for hundreds of years? Well, unfortunately, what we learned was that the opposite, that these experienced bankers in the main understood risk better than the risk modelers did, or at least that they knew enough to know what they didn't know, which was the difference between what happened in previous financial panics and what happened in 2008. We now know, actually, that in a competition between computers and computerized algorithms and human judgment, the combination of the algorithms and the judgment outperforms both the algorithms and the judgments. That a better chess game is played by a human with a computer than by either the best humans or the best computers. But it's always true that the answer a computer will give you to a question depends on how you frame the question. The world has got more sophisticated since I made that mistake. So I asked Transport for London, how their website, how to tell me to get how they recommended I go from Paddington Station to Hyde Park Gardens. And they told me I should take a bus one stop north from Paddington. I should walk slightly north from Paddington, get on a bus, take it one stop south, get off the bus, and walk to Hyde Park Gardens. It is the best way if you insist on using the services of Transport for London. It is better not to use the services of Transport for London at all. But that's not the perspective that the Transport for London computer or the people who programmed it see on it. Now, financial economics for the last 60 years or so has been dominated by a group of models which have been treated as if they pretty much represented true statements about the world, at least if they were akin to the laws of Newtonian mechanics. But the efficient market hypothesis, which has come to dominate so much, is best described, I think, as a model which is illuminating but without being true. If you don't understand the insight that the efficient market hypothesis gives you, which says that publicly available information is typically incorporated into securities prices, you won't be a successful investor. But if you believe the efficient market hypothesis is completely true, you won't be a successful investor either. Friedman Savage used in this context the analogy of the expert billiards player. He plays shots, Friedman and Savage, who defined the subjective expected utility theory, which is the basis of financial economics. Today, they said, think of the analogy of an expert billiard player. He plays shots as if he understood the differential equations which govern the movement of the cue and the balls, even though he doesn't know what these particular equations are, and couldn't understand these equations, even if you explained to them. And, of course, what Friedman Savage said is right. Expert billiard players do play very good shots, but they don't play perfect shots. If they did play perfect shots, the game of billiards would be extremely uninteresting and people would stop playing it. It's because of the slight imperfections that the game is interesting. And that analogy goes through directly to securities markets. The efficient market hypothesis, in a sense, contains an internal contradiction. If it were true, if people held model-consistent expectations and believed it, no one would trade because everything would be in prices already, except nothing would be in prices already if nobody actually traded. The insight matters, and the exceptions to the insight matters as well. So, a century ago, there was a theory provided about in fact, I might just show you the next slide, which is Warren Buffett's take on that, which I think expresses it rather neatly. Observing that markets were 90% efficient, people acted on the basis that they were 100% efficient. The difference between the two is night and day, or in the case of Warren Buffett, the difference between the two is about $100 billion. There is a very large difference. We need to see that economic models can be illuminating without being true. It's the deviations from the optimum that make the game of billiards interesting. It's the deviations from the optimum that make the financial world interesting. And unless we understand that, we're going to be blind to profit opportunities. Indeed, it's imperfections in the market system that are the source of profit opportunities. Frank Knight had understood that a century ago when he wrote a book, Risk, Uncertainty and Profit, in which he explained that it was uncertainty which was the source of profit opportunities, and it was that uncertainty which was essentially the fundamental dynamic of the market economy. And Keynes made similar arguments which underpinned his approach to rethinking macroeconomics with its emphasis on animal spirits. Keynes said, by uncertain knowledge, I do not mean merely to distinguish what is known for certain from what is only probability. The sense in which I'm using that term is that in which the prospect of a European war is uncertain, or the price of copper, the rate of interest in 20 years hence, the obsolescence of invention, the position of private wealth owners in the social system in 1970. About these matters, there is no scientific basis to form any calculable probability whatever. We simply do not know. That was Keynes's position in the book he published simultaneously with Knight's, in fact, in 1921, and it remained Keynes's position in his general theory 15 years later. But that insight was brushed aside in the years after the Second World War, and the economics of uncertainty since then has been dominated by an axiomatic approach which purported to define radical rational choice under uncertainty. Conformity with these axioms of rational choice could be described as the maximization of subjective expected utility. And Milton Friedman, who with his colleague Jimmy Savage was the architect of this subjective expected utility program, declared in 1962 that, let me get this right, in his seminal work, Frank Knight drew a sharp distinction between risk, referring to events subject to a known or knowable probability distribution, and uncertainty, as referring to events for which was not possible to specify numerical probabilities. I have not referred to this distinction, Friedman said, because I do not believe it is valid. I follow Savage in his view of personal probability, which denies any valid distinction along these lines. We may treat people as if they assign numerical probabilities to every conceivable event. And that is the claimed implicit basis of rational choice under uncertainty, which has been the dominant paradigm in financial economics for the last half century. And yet, beneath my flat in London, there is a betting shop, which every day displays starting prices of various horses in the window. I can tell you that I've never once thought, these odds are a bit out of line with my subjective probabilities, I must go in there and make a killing. People don't have subjective probabilities about most conceivable events, and for very good reasons. Information is imperfect and unevenly distributed. And in the face of that, far from being irrational to form prior probabilities, it is actually irrational, perhaps to form, but certainly to act on these probabilities. I can be confident that whatever the odds are on Dobbin in the 3:30 at Kempton Park, there is somebody else who knows rather more about that subject than I do. And that is, I have to confess, true of a great many things. There are other people who know more than I do. The capital asset pricing model was developed by a group of economists in the 1960s, and essentially it described a market equilibrium which would be reached by maximizing agents rationally following the precepts of subjective expected utility. Recently, a former student of mine, who's actually now a professor of finance, asked me, so you no longer believe in the capital asset pricing model? I think the framing of the question was quite interesting. So you don't believe in it? After some thought, I replied, and I think this was the right answer, I'm glad I know about the capital asset pricing model, because I know that there are a lot of people around in markets who believe it. It is an essential tool of the financial economist, not because it's true, but because it could be true, because understanding why it might be true yields insight, understanding why it's not true also yields insight, and the fact that many people believe that it is true is useful information to have. But as I've argued, economic models may or may not be useful, but they're not true in the sense in which it's not a big mistake, at least, to regard the laws of Newtonian mechanics as being true. Mervyn King and I developed a detailed critique of this subjective expected utility book in our recent book, which Gerd was kind enough to mention this morning. And I'll only sketch out their basic arguments. But the key point is that rational individuals do not attach probabilities to every conceivable event, or even very many conceivable events, in a world in which information is necessarily imperfect and unequally distributed. It would be irrational to do anything else. The rational response to individuals asked to report such probabilities is, I don't know. And then, if it matters, I will try to find out. And only rarely will the answer be sensibly expressed as a probability or a probability distribution. We argue that uncertainty arises essentially from imperfect information. Imperfect information certainly about the future, probably about the present, and possibly about the past. And then there is imperfect information which is resolvable. And it's typically resolvable in one of two ways. One is it's resolvable by obtaining further information about the question. Or it's resolvable by being able to frame a probability distribution of the possible outcomes. But there are a lot of things which are conditions that need to be fulfilled if you are to frame a probability distribution of the probable outcomes. The remainder is what we call radical uncertainty. And that arises because problems are often characterized by ambiguity and vagueness. I used to think vagueness was some kind of weakness of human character. There was a philosopher at my college who studied vagueness, and everyone laughed at him, especially since he was the kind of person whom one thought ought to be studying vagueness. It seemed to describe his character. But I've come to realize that vagueness is actually an essential property of the world. Will the war in Ukraine be won or lost by Russia? Well, the answer may be vague and ambiguous even after many years after this particular event has been resolved, to the extent that it is resolved. Vagueness originates in the famous philosophical problem of the heap. If you have a heap of grains of sand, how many grains can you remove from that heap before it ceases to be a heap? And the point is obviously that there is no sensible answer to that question. Although there is a distinction between heap and not heap, there is not a clear point at which not heap becomes heap, or vice versa. Indeed, Friedman's co-author, Savage, limited the scope of his formulation to what he described as small world problems, typically games of chance in which precisely calibrated uncertainty has been designed into the problem. And actually it's quite amazing that casinos spend a lot of money to ensure that the outcomes of their processes are genuinely random. There are very few events in the world which are genuinely random, although there are quite a number that are approximately random. But the idea that randomness is a property, and that everything we do not know for certain is random, is a deeply profound mistake. So most real-world problems of business and finance do not meet the conditions that Savage described for a small world. Information remains imperfect, Not all possible outcomes are known, and typically they're characterized by vagueness and uncertainty. Humans more naturally think in terms of narratives than they do of probability distributions. We need to be more modest in what we are expecting from economic models. A few years ago, I gave a talk in which I described George Akerlof's famous lemons model. Many of you will know it. It describes how markets may fail in the face of imperfect information. And it comes into being because the term lemon was widely used in the United States to describe the General Motors cars which were made on Friday afternoons after the workers had come back from the bar at lunchtime, and which were of somewhat lower quality than the ones that were made earlier in the week and before lunch. During questions, an interlocutor announced that he was the General Secretary of the Retail Motor Federation, which represents used car dealers in the United Kingdom. And the story I told was a monstrous libel on his hard-working members. Whether you share his opinion of the hard-working members of the Retail Motor Federation or not is an open question. But the really more fundamental point is that the story wasn't about cars at all, any more than Adam Smith's description of the pin factory was about how you make pins. It was a narrative mechanism for expressing a particular mathematical or logical proposition. And that's what the majority of useful economic models are. That means there aren't right and wrong models. It means we don't have better models by making them more complicated. We have models which are very bad because they're of no operational use, but we have no one model which is clearly better than any others. Models should be adapted to the particular purposes for which they're used. And the skill of the practical economist is to know when to apply which models in a particular case. Thank you.
Good afternoon. It's a real pleasure to be here. I wish I could be with you in person, but I'm just not able to. We're living in the most amazing time of my career. The two largest economies in the world are deliberately bursting bubbles. In the case of the Fed, they are raising interest rates, and they've said they want to basically destroy wealth to make sure that consumption decreases so that they can tackle and deal with inflation. In China, the government is deliberately trying to burst the property bubble. So never in history have we been in a time when the two largest economies in the world are both targeting bubbles. It's never happened before. How it unfolds is anybody's guess. But I'm not here to talk about that. I'm here to talk about what I think is the most important question in the world, most important economic question in the world. And that is, how long will the green energy transition take? I'm going to give you a couple of statistics. The first is that there are 1.3 billion vehicles in the world, and 95% of them use liquid fuel, and that means petroleum. And it's transportation that accounts for 60 to 65% of oil demand. Now, how many electric vehicles are there? There are only 15 million. And the most optimistic projection I've seen is for maybe 24, 25 million per year by 2030. That's obviously not going to do it. And there are other significant roadblocks. And that is, number one, because of the rising cost of everything, the cost of producing an electric vehicle has gone up. Tesla, for example, last month raised prices 3 times. And the critical components of an electric vehicle, lithium, cobalt, nickel, and copper, are all in short-term supply and long-term supply constraints as far as the eye can see. A typical electric vehicle uses 80 kilograms of copper, as an example, versus 20 kilograms for an ICE vehicle. And the problem is that while there's enough copper, it's going to take 10 or 15 years to get it out of the ground. And we also have a shortage of mining engineers on top of it, because the last decade was so terrible in the industry. Nobody wanted to be in that industry and was considered dirty and anti-environment. There also is the problem that our estimate is that there's probably $7 to $8 trillion embedded in the existing auto fleet around the world. And because of inflation, people are going to hold on to those cars longer rather than trade in for an electric vehicle. So if this is true, then this means that OPEC Plus has never had more power than it has now. It already accounts for 65% of global oil production. And this is at a time when China and Russia are moving into the Middle East and the US is moving out. It's an extremely important point, because if this is right, it means that oil prices are going to stay high and go higher and higher, and there is no way to control it, which means that inflation will keep going up, which means that bond yields will also increase unless central banks try to keep them under control, as the Japanese have done by basically letting the yen collapse in order to keep the 10-year JGB anchored at 25 basis points. So I want to leave you with this message that the energy transition is going to take much longer than anyone thinks. 10 to 15 years, at least, maybe longer. It's a very significant point that we must understand. Thank you so much for joining me in this talk.
So my question is really about governance and rather than the technical problems with ESG, but really about whether or not the problems of governance are going to make the ESG transition even longer. So can we rely on individual investors or companies to pursue ESG transitions? And maybe shouldn't we perhaps be looking at a more directed economy to deal with a lot of the environmental problems that we're likely to face in the near future?
Well, I think you're aware of that. It's already one of the hottest summers we've ever seen. You look at India, the Southwest America is just a nightmare. So, the climate issue is front and forward. And the question is, which is going to take precedence? And I fear, to my great regret, that there's going to be backsliding on ESG, and there's going to be renewed focus on fossil fuels. If my case is right, that we're in this situation where oil is not going down anytime soon. And we very well may be experiencing peak oil, which was a big theme of mine in the decade of the 2000s. And there was an interruption of 10 years because of the shale revolution in the US. But I think that's run its course, so I don't expect to be miracles there.
I guess my next question you've almost addressed there, which was really going to be, should we be divesting from fossil fuels? And I will also ask the audience, if anybody would like to come up and ask a question, then please do so.
Well, I say that Mr. Market is a cynic, and the divestiture of fossil fuels from institutional portfolios, one could argue, is what has caused this crisis, if indeed my assumptions are right. And the oil companies were forced to abandon investment in the future to distribute cash to shareholders via buybacks and dividends. So it's terribly ironic, and I say it, Mr. Market is a cynic, that the best performing asset in the world is energy stocks this year and for a lot of last year. So I don't know how it all is going to play out. We're going to have to evaluate only with the benefit of hindsight. China, of course, is moving back to use coal, and I would argue is changing its huge impetus. When you look at the European situation, I'm in Switzerland at the moment, and I took a helicopter ride across the canton of Ticino, where I live. And a lot of Switzerland is powered by hydroelectric, and this happens to be one of the major ones. And the aquifers were dry, and they're even talking about brownouts occurring in Switzerland this summer. So it's going to be a toss-up towards what does humanity decide is the priority. And when it comes down, push to shove, it's going to be, do I have food on my table? Can I feed my family? And am I able to survive? And I fear that the environment is going to take second fiddle here.
The central banks talked about that inflation was transitory. You describe a situation with oil prices staying high or going higher. There have been analysts describing a situation which I've called stagflation light, which would mean that we do not need much inflation for growth and returns to turn negative in real terms. Do you have sympathy with the scenario of stagflation light?
Well, the UK is already in stagflation. I think we have to step back and look at the causes of inflation. Now, for 40 years, we were in a period of disinflation. There were a lot of unusual things that happened. Eastern Europe and China admitted to the WTO. In effect, the labor pool doubled. Interest rates were highest in 2,000 years in 1983. I wrote a book called Is Inflation Ending? Are You Ready? And there were 4 people on the planet who believed that was true, my co-author being one, me being one. And so you had this massive decline in inflation and interest rates. Of course, capital was deployed in technology. And the demographics initially were very favorable. And now the demographics are unfavorable because the labor pool is shrinking all across the world. And it's the biggest decline in the working adult population in the history of records. And then you have what I call the cycle of wealth creation to wealth distribution. And I was present at the beginning of the cycle of wealth creation in 1978. I was a supply sider, probably the 7th or 8th supply sider. I knew how it would impact the world, and I watched it unfold. And then it became clear about 10 years ago that it was the inequality had gone way too far. And if you wanted to maintain stability, economic and political stability, you had to right that to some degree. And it first began in China, where they mandated manufacturing wage increases. And then it was the President Xi coming to power on the anti-corruption campaign, Brazil, car wash, Brexit, Trump, et cetera, et cetera. And we're in the early stages of this. But the key component is that labor is in the catbird seat. And as you've seen, wages are going up all over the place. The problem is, so is inflation. So real wages are not going up. Taking a page from Lacey Hunt, who has argued for years that the more debt you add to the economy, the more you slow economic growth. Of course, he believes that debt is disinflationary or deflationary. But I think there's a lot to be said for the concept that the more debt you add, the greater the deficits, the more you're going to reduce growth. And sooner or later, you reach a point where you can't add any more debt, particularly if interest rates are going up, which they are. The unanswered question is the Fed and its staying power. So Powell supposedly has gotten religion. He's a reformed smoker. He really wants to not be recognized as the Fed chair who lost 40 years of disinflation. And I would argue, did he want to be known as the Fed chair who caused a global bust that couldn't be put back in shape? And there's so many areas where there could be financial accidents. I mean, I could go on for 3 hours about debt is one. I think I was reading somewhere that 30% of the companies on the New York Stock Exchange can't meet interest payments because their debt is too high. So they have to borrow money to do it. That historically for emerging countries has always been a sign of hyperinflation when you have to borrow money to pay interest. So the unknown is what happens if the Fed pivots and what causes them to pivot. They have to maintain this tightening policy here, and they have to do it until there is an accident because they lost credibility because of the transitory. And if reality be faced, the central banks are the cause of all the financial crises since the Fed was invented. And they will continue to be until something is changed. So I think the odds of stagflation are very high. The real concern I have is food. And food is what causes social unrest. If it's unavailable or it can't be afforded. And if you remember, the Russian wheat failure of 2011 was what caused the Arab Spring, which of course has failed. And even Tunisia, which is the one country where you have some hope, even that one has now backtracked. And the problem is fertilizer. We've been warning about this for months and months. Fertilizer has gone up 250, 300%, and farmers can't afford to buy it. And some aren't even planting. So we don't know how much yields are going to go down. Ukraine, Russia planting and how much is going to be available, I mean, that's anybody's guess. You know, this person has this opinion, this person has that opinion. But for one thing, it's clear there's going to be a lot less of it. And you've seen that India is embargoing wheat, Indonesia embargoed palm oil, and this is the beginning of a trend, which is extremely dangerous and very worrisome. Now, if the Fed is committed to create wealth destruction in the US equity market, and by that inference, rolling over into the world, then the question is, will this demand destruction, wealth destruction, create demand destruction? And that's the $64,000 question. I, for one, don't think they're going to have the courage to ride this through very long. And that financial crisis that emerges will occur in the next 2-3 months, 4 months maybe, and that there will be a huge pivot. So even if there is some demand destruction through negative wealth effect and demand destruction because of higher prices, I think it will be transitory.
Kiril, I want to ask a broader question about your relationship with Mr. Market. For someone who's been watching Mr. Market for over 30 years and advising institutions for over 30 years, I watched an interview you did recently with Stanley Druckenmiller, who said that the signals, the way the market talks to him, has broken down. It doesn't work anymore, probably because of intervention by central bankers and governments. Do you agree with that? And if that market is breaking down, if the signals are breaking down, is that in itself dangerous, that we have getting Are we not getting the wrong signals from these markets because of the scale of intervention? And if so, what does it mean?
Well, actually, it's been 40 years I've been doing this. And I interviewed Stan back in September of 2018. He's been a client for a very long time. What he's saying is that markets are not free, they're manipulated. And if you don't have an investment rate, and the key investment rate really is the long treasury, then you have no benchmark to go off of. Currencies are manipulated. You would argue that equities are manipulated. Certainly have been. The Greenspan put and the Bernanke put and the Yellen put and the Powell put, that's all manipulation. So markets are not free. But what we do is we study hundreds and hundreds of charts, and you can see trends and you can see opportunities in capital allocation. So in September of 2020, it became clear to us that there was regime change going on in the markets and that the old leaders, the big technology was peaking on a relative strength basis. And what was starting to come alive was the sectors that hadn't done well. The inflation sensitive, the commodity sector, materials, et cetera, energy. And that's exactly what has transpired. And now as we speak, we see the same thing. If you look at the charts for corn and wheat, the base that has been built is just absolutely monstrous. And if you break out of that base, I can't even imagine where those two agricultural commodities will go. So while Stan is absolutely right, there is a way to do this. And he also made the point that algos have distorted the market because they do 80% of the trading. And if you look back historically, as they do 5 or 10 years, it's such a limited time bandwidth. And you used to be able to short a stock after they had a bad earnings report. But now, and this is again from quite a few years ago, he said this, but it still applies. The markets are so distorted because of the algos and how they trade, and they trade off of a news event. If you remember during the fight between Trump and China, you would see trade deal, and all of a sudden stocks would explode because the algos hear it and they're programmed to buy. I mean, it's lunacy. It's absolute lunacy. And there was an analyst at Morgan Stanley who said, this is all going to come out badly. There's going to be a crash because the algos are trained to buy, but they're not really trained to sell. And I remember in China, I think it was 2015, there was a lot of algo trading. And they had to close the Chinese stock markets because once they started to sell, there was no one on the other side. So it's just another example of lack of regulation and problems that are coming home to roost.
Thank you, Kiril. Can I go back to the point you made, which for what it's worth, I 100% agree with, about the dangers from food price inflation, which you've pointed out also, if you just look at price charts, has got distinct, unpleasant-looking characteristics at the moment. One of the things I'm sort of struggling with is, in terms of geopolitics and in terms of how the market is going to be impacted by that. What thoughts have you had in terms of a market that's has been very focused on energy costs and the impact that has, for example, in Europe? But I think this food issue, as you say, is potentially much greater, both geopolitically and on the market. I just wondered if you'd drawn any conclusions yet on what you expect to happen if that does come true.
Well, the central banks are tightening, at least the Fed, ECB is behind the curve, and the PBOC is loosening because of inflation. And so it's a dicey situation because the worse the inflation becomes, the more the pressure is on, let's use the Fed to tighten. But the more the Fed tightens financial conditions, the greater odds we're closer to a financial crisis. But if I'm right that at some point the Fed will pivot, then all bets are off, because when the Fed does pivot, the dollar's going to get very weak. And that's been the missing ingredient so far in inflation numbers. In 1978-79, which is the last real inflation the US had, it was the dollar was incredibly weak. So it's a catch-22 here, and we just have to keep watching and be totally flexible.
Okay, thank you very much, Kiril. Can I ask the audience to say thank you? And okay, so now we move on to the questions for John. And are you ready for questions, John? Yeah. So I'm just going to ask a question, really, because I thought John's talk was really very interesting, excellent actually, and I was coming over using my sat nav, and it's a Spanish car. It's not the most expensive car you'll ever come across, and it's a Spanish car. And actually, for the last sort of 10 years or so, I've been using the sat nav, and it doesn't have the M8. The map isn't even particularly good, depending on where you get it from. I think car inflation as well, Kiril was talking about, was car inflation is also extremely important, and I was looking at whether or not to buy a new car recently. My lease is up and it's time to get a new one, but I can't afford them because it's gone up about £8,000 compared to the previous version. This is the same type of car, so the inflation is extremely, I think, concerning at this point, and I think that's one thing we could be talking about. But I'm actually going to ask a question that goes back to 1995 and to one of my very first lectures, I think. And I inherited my corporate governance course from Dr. Dambolt, sat at the back. So he may have used this quote, I'm not sure. But Kay and Silverstone said that the only restraint on CEO compensation was their own modesty. And that was increasingly in short supply. I've used that quote in every lecture for 25 years or so, and the ratio of CEO pay has tripled since 1995, the ratio to the average worker. It was about 100 times, it's now about 300 times. So I think stock options are fundamentally flawed, and I think it's very clear. And I've read many articles in the Financial Times, including written by Merrin, that these things are just, why are we still using them? And I suppose my question relating to models and to radical uncertainty is really just, why are we still using models which we all know do not work? How is it that these are perpetuated?
Right. It's an interesting question that raises a whole variety of issues, from the way in which, bizarrely, stock options were introduced under the illusion that this was a way of aligning managerial incentives with shareholder interests. In fact, they've become the primary cause of friction between managers and shareholders. Now, that then takes us into deeper questions about the nature and models of the firm. The models of the firm that have dominated economics for the period in which I was talking about, the models of financial economics that have dominated, the models of the firm, are all predicated on the basis that the archetypal firm is General Motors. And General Motors is really a souped-up version of Adam Smith's pin factory. It's a repetitive manufacturing process in which it's not difficult for someone at the top to decide what everyone needs to be done, what everyone needs to do. And then the problem is simply a sequence of cascade of principal agent problems in which you need to motivate people who are assumed to be lazy and only are interested in money. They need to be motivated to do what needs to be done. To my mind, that doesn't bear much relationship to the typical modern business. But it's still the model that's there and dominates. and indeed one only has to go back to 2016 to see a Nobel Prize being awarded for an elaboration of that particular model. I think if we want a real useful model of the firm, we learn a lot from the discussions in the course of today. We need to understand that firms are not described by the distinction between markets and hierarchies, but as collections of capabilities, that they are the product of distributed cognition, collective intelligence. The firm is a vehicle of collective intelligence. That if one takes the modern example, which is closest to the General Motors pin factory kind of story, most complicated modern manufactured products are civil aircraft. Nobody in the world, literally, knows how to build an Airbus. 10,000 people collectively do. That's the reality even of modern advanced manufacturing business. In the case of what is Apple? Why does Apple have varies from day to day nowadays, but let's be safe and say 2 trillion market cap, and assets, tangible assets, which are almost nothing, and which are dominated, in fact, by the cash it has in the bank, because it doesn't know quite what to do with it. Well, people can invent the story of the Apple brand to try and account for that, and they do. Intangible assets. Well, if that has any content, it has to be more specific than that. There are valuable brands like Persil and Coca-Cola and Price Waterhouse, but Apple is not that. It's the capabilities of Apple. It's the collective intelligence that is Apple, that is the product of the value in that. And that collective intelligence is in turn built up modularly from the variety of collective intelligences within Apple that are built up in teams within the organization. So that's how we need to think about it. Now, that leads us back to your question of, if these models are so crap, why do we go on using them? Well, the answer is a depressing one. One has to give to students wanting to do PhDs, which is, if you want to get an academic job, the way you do it is you publish an article which is not very different from all the other articles that are published in academic journals today. That is, I'm afraid, true right across academic life. But it's why, I think it was Max Planck who said that science progresses one funeral after another. And perhaps we need some of us to be cleared out to enable PhD students to work on subjects that might actually be interesting to them and useful to the development of the subject.
Well, I suppose the one thing that I just want to follow up quickly on that, but I suppose the one thing that I would say is just that if we can't fix the agency problem relating to one individual in the company, how are we supposed to ask everybody else in the company to follow ESG policies as well, or reduce our agency costs? Isn't the fish rots from the head? And so it concerns me greatly, really. I think in one of your books you say, is greed dead? And I'm not sure it is yet.
It certainly isn't dead in corporate boardrooms, that's for sure. And what we need to do is actually the real problem of ESG is not the rather superficial box ticking with which it's typically concerned. The real problem is how we get mechanisms of effective managerial external accountability for management. At present, to my mind, there are 4 mechanisms of accountability. There are non-executive directors, there are asset managers, there are regulators, and there are auditors. 4 mechanisms of accountability for incumbent executive management. None of these are working terribly well. I think part of the answer, probably the largest part of the answer, potentially lies with asset managers, getting them to take a more effective role in controlling companies, which means rather less preoccupation with quarterly earnings and quarterly performance reporting, and a lot more with the substance of corporate, what is going on in corporations. I would like to see a CFA course that's a lot more about business and business strategy and a lot less about finance and financial markets. And maybe over time we'll get there. We also need to reform the audit profession. I'm not very sure what it's for, other than a different kind of box ticking. We need, I think Bryden's report there pointed the way of having a much more, of recreating a real profession of auditing, which is very different from the one we have today. We need to explain to non-executive directors what their role is, which is not at all clear at the moment. Are they monitors? Are they themselves quasi-executive? Are they consultants? The role at the moment is a mix of all these things, again, none of which are done very well. And we need to have regulation. We have an issue at the moment in financial regulation in particular. It's the idea that it might be about, its purpose might be to promote competitiveness rather than competition and the public interest. And I hope we can resist that. Or regulatory capture is a major problem in all regulated industries, including financial services. But we have these 4 mechanisms of accountability. We need to bolster them all and actually, I think, have a profession of managerial accountability.
Okay, so we'll move over to the audience. There was a guy who put his hand up first over there.
Yeah. Thank you, Professor, for the presentation. It was quite interesting. My question goes regarding you presented the map, and what I have been thinking about is that nowadays, I mean, there is a second layer of algorithms and models which are focused on choosing the best map. So if we get Google and we open Google Maps, we put the 2 points that we want to go. Google will give us 4, 5, 6 different options depending on if we want to walk. So we have this second layer in, at least when we are talking about Google, etc. On economics, something I was thinking about is like, if we have the right tools, or at least the right toolbox, so wouldn't a second layer of algorithms that can allow us to choose which model is the best for each specific situation, we could use them. But then for that, we would assume that we have good models. At least we have a toolbox with enough models that can allow us to choose something. And I was thinking about that in the context of what you mentioned about the PhDs and etc. I've been going through this process very recently, and I try to develop something like more in the agent-based modeling than in the SGE, try to discuss micro to macro models. And it was really hard to publish. It was really hard to not be desk rejected to any economic journals. And the argument is usually because it doesn't have the assumptions. So in order for me to publish it, I had to move away a bit from economics and go to management, to business, to a good journal, but that is not so strict on the model. So economics kind of closed itself in that specific toolbox, and it seems like my perception, it doesn't offer the alternative to find all the different tools that we could use for the specific situation. But I'd like to ask your perception of that. This second layer could define us like a better condition that we can use the right models, or actually will just make us choose the wrong models because we don't have good ones. But that would be my question.
Right. Two different questions there, I think. One is what you now use Google Maps for, and it's better at helping you with the map than before. But Google is not, you are not saying to Google, I want to go to X, and it says this is what you should do. You have to input what your preferences are in order for Google to recommend the appropriate thing, given your preferences. This is the point that the algorithm plus the human judgment beats either the algorithm or the human judgment unaided. In terms of how you get your articles published in journals, well, I probably don't have to tell you the standard templates for publishing in an economic journal. You either create something called the model, which is preferably tweaking the assumptions on some established model, or you do some piece of work on a large data set. And that's what journals are looking for. And I'm afraid one could tell the same story about most other disciplines in universities at the moment. Peer review has many virtues, but it also has the vice of giving relatively little scope to things that are genuinely original. And the story, which is certainly common in economics, of the articles which were widely rejected before they were published and won Nobel Prizes for there are, in fact, I cited one in terms of Akoloff's Lemons article, which is one of the most influential articles over the last 50 years, but was, I understand, widely rejected before he finally succeeded in publishing it.
Thank you. Just a small point. I'm Roy Leckie. I'm an asset manager, so I do agree with your contention that asset managers have a hugely important role to play in holding management to account. But I think I would probably rank highest amongst your agents for accountability would be clients or customers. It's the company's customers and or clients that need to be satisfied most for the company surely to exist.
Yeah, they need to be satisfied for the company to exist. That's perfectly clear. What they don't have is the ability to have any direct connection with the behaviour of the incumbent management, other than that of liking or disliking the products they put on the shelves. I'm not going to buy or not buy products because the directors are paid too much.
John, I've been involved in trying to change the CFA syllabus. So
Right.
after the great financial crisis, their members said it would be good if we had an exam on financial history, so not business strategy. And they all agreed that would be a good idea. They agreed that it would be a good idea to teach it. They agreed it would be a good idea to examine it. But ultimately, it was too time-consuming and expensive to market. So it never happened. So it was really economics, I think, that stopped that particular one coming along. So I'm interested in both stages of your career as an economist, because the early days were in a very different system where the capital markets, or Mr. Market, in the capital and finance played a more limited role up until 79, lifting of exchange controls, Thatcher Revolution, Mr. Market, capital markets play a bigger role. I wondered what you thought economists had most got wrong, what they didn't see coming, what they misunderstood about this system that was coming, that was different from the past. Obviously, I'm slightly interested from my own perspective. If we start to reverse it, what are we going to be surprised by most if we start to reverse the process? But having been an economist before we opened up the free flow of capital, before the financial markets played a role, what was the biggest surprise? Or was everybody not surprised? Everybody fully understood what the full consequences of this opening
No, Russell, in fact, I don't think they really understand it now. Because the great paradox of the period since 79 is that on one hand we've had this huge expansion of capital markets, the finance sector and capital market activity. On the other hand, capital has actually become less and less important to business. I described Apple as having negligible operating assets. It's a hollow corporation in the modern sense, that it makes very little of what it sells. It has, as I described, very little in the way of tangible assets. It has nothing in any recognizable sense in the way of assets at all. Apple, if I remember, raised $100 million at its IPO, and that's the only external equity it has ever raised.
But is the reason for this that all of that other type of capital was built in China? So globally, we have been creating it. We just haven't been creating it in the United States.
Yes, to a degree, we have been creating in China, so that Apple's manufacturing is in China, not in California. But if I'm talking about where the value is in the equity sector, it is in Apple. It's not in Foxconn. But that's the paradox I was describing, and that I think we did not see some coming. It's not that capital is more important; it's less important. It's that capital market activity is much larger, and it's only, I think, if we think in these terms that we can understand many of the very strange things that have been going on and are going on now.
When we're talking about the market, we're talking about it reflecting the view of investors. But of course, it also reflects the view of the government, but also the corporates themselves, because they buy back a lot of their own equity. Would you continue to allow corporations to buy back their own equity, or would you put any limits on the ability to do that?
I don't see that the problem is that we have a problem of lack of investment. We don't have very much investment, but that's not the same as a physical investment. But that's not the same as saying it's a problem. And we have, as it were, a world in which the provision of capital services is itself a specialist business. So a company like Amazon, which has raised all the money it could possibly want. In fact, it rents the bulk of its warehouse space from companies like Prologis. Few people have heard of Prologis or Aerocap, which Aerocap owns is the largest single owner of aircraft in the world. Prologis is the largest owner of industrial real estate in the world. The fact that hardly anybody has heard of them is an illustration of how unimportant their role in modern economies are, and how different the world we're now living in is from the world in which the owners of capital control business. Aerocap doesn't control the global aviation industry.
So I wanted to ask a question which sort of relates to that and to the previous discussion about how a consumer can influence CEO pay. So on the first one, you're describing an economy where it is the capacity to assemble multiple elements has become absolutely critical, wholly unlike General Motors or Standard Oil, or for that matter, a bank. So question number one, what happens when that sort of complex capability becomes the core of an economy? What concepts does economics need to understand that, to measure it, to interpret it? And I think there's a parallel with the customer influence on CEO pay. So it made sense in the past when communication was expensive that very low bandwidth communication was the way decisions were made. So in a market, it was you either bought or you didn't buy. In democracy, you either voted every 4 years or not. Now we have very cheap bandwidth, ubiquitous bandwidth, and so there are many, many more ways I can communicate what I think about the chief executive's pay. I can choose to buy or not, I can post on Instagram, I can have petitions, there's multiple ways of communicating, so the market mind has become far more complex than when it was just about price signals. So there's sort of two related questions about what therefore is needed in economic theory to cope with this dramatic transformation of the very nature of the economy.
I mean, I can say what I think about Jamie Dimon's pay or David Solomon's pay, and I imagine most of the people in this room think the same thing. It doesn't, I think, have the slightest effect on what concepts do economists use. They're there. We've had a theory I described this kind of standard theory of the firm in economics, which is co's, markets and hierarchies, principal agent models. We've had for 50 years an alternative group of theories in terms of capabilities. It started with Edith Penrose in the 1960s. Someone like David Tissot was here in this house not so long ago with David talking about dynamic capabilities as a source of competitive advantage of the firm. That's where the group of capabilities we as economists need in order to understand modern firms really are. And we're still we're still in the world of markets and hierarchies, I'm afraid. I took the example of Hart getting the Nobel Prize for elaborating the markets hierarchies framework in 2016. I was quite interested to look at his Nobel lecture and discover that the example he'd used to illustrate the proposition of did you want to vertically integrate or not was if you had a coal mine, did you want to locate it next to the power station or not? And first of all, one might feel this was a 20th century rather than a 21st century case to take. Secondly, rather interestingly, it was not accompanied by any empirical discussion of this. The empirics of it are quite interesting. The largest coal-fired power station in the Western world, at least, is in Georgia. And the coal for it comes from Wisconsin, 2,500 miles away. And it comes from Wisconsin, which is the largest coal market in North America, through a dedicated shuttle operated by Berkshire Hathaway. There is no vertical integration at all in this process. Brown coal, however, low-quality lignite, which is extremely environmentally unpleasant, is very expensive to transport, and you can't ship it from Wisconsin. One of the oddest experiences of my life was flying down from Melbourne to the Latrobe Valley in Victoria. The Latrobe Valley is one of the world's largest deposits of brown coal lignite, and it still produces the bulk of Southeast Australia's electricity. That's probably changing and may change faster after last weekend's results. But anyway, there are the Latrobe Valley looks like kind of hell on earth. There are probably the largest vehicles in the world shovel this brown coal into coal-fired power stations. There are two stations there. Sorry, there are two stations side by side. There's Loyang A and Loyang B, both of which are dependent on the Loyang coal field. It turns out that Loyang A is owned by the people who own the Loyang mine. Loyang B is not owned by the people who own the Loyang mine. What we've learned in looking at these kind of vertical arrangements everywhere is that people work them out, and there are no generalizations that preclude them. The fact that you've had for 30 years two equivalents side by side with completely different contractual structures and stability of the two is a forceful illustration of the point. But I could have many others to illustrate the point. Coase, rather paradoxically, revealed this when he gave a lecture quite late in his life. And those of you who do industrial economics will know there are endless articles written about General Motors' acquisition of Fisher Body. It is as though this were the only vertical integration merger there had ever been. Coase said he did not mention Fisher Body's acquisition by General Motors, and he didn't because he'd noted the paradox of a similar company called A.O. Smith. The point was that A.O. Smith made the chassis. These were in the old days before unibody construction. A.O. Smith made the chassis, and Fisher Body made the bits you fitted on the chassis. General Motors acquired Fisher Body. They never acquired A.O. Smith. Pretty clear, looking at the archives, that the reason for that was that the Fisher brothers rather fancied their chances as executives in General Motors, whereas the Smith family wanted to retain an independent company. The economic story turns out to have no explanatory power at all. As in the Latrobe Valley, you really need to look to sociology for the explanations. We need to think about the theory of the firm in different ways. that go back to this more sociological, anthropological capabilities-based view of the firm than the markets and hierarchies one.
Do we have any more questions?
Thanks. I want to come back to the question from Eddie, but dial it up a little bit. And my question this morning to Andrew was about the seriousness of the crisis and the lessons that we should learn from them. 2011, you summarized 2 of your FT columns for INET and argued revising economics, criticizing the rational expectations hypothesis. So beyond models being wrong, what if models are not just innocent observers, but influence policies and even investment strategies, and then actually have a negative impact? So when, for example, Harry Markowitz in 2005 is critical of the CAPM, particularly criticizing the assumptions of unlimited borrowing and unlimited shorting, and then says it's time to move on, CAPM is still part of many mechanizing investment strategies. In fact, the ones that are generating more and more assets under management, etc. What if the models are not innocent but are negatively impacting the real economy, etc.?
I hoped you were going to tell the verified story of Harry Markowitz, the inventor of modern portfolio theory, being asked how he'd invested his retirement fund, and he said half in bonds, half in equities, which indicates the faith he had in the theory which made him famous. Sorry, the distraction there. Going back to why are we still using CAPM? Well, I think we've got explanations for that in terms of the way in which the academic world now runs on well-established tram lines. And if you want to get a good job in a finance department at a business school, that it's in that tradition that you ought to publish your articles. Do the models have malign effects? Yes. Now, and we have 2 striking examples at the moment. We have essentially relied on a model of central banking in which we said if central banks declared sufficiently firmly their commitment to an inflation target, then rational expectations would lead people to internalize these inflation targets, and therefore all you needed to do was repeat rather firmly that inflation is going to be 2%, and it would be. Well, we're going through a test of that at the moment, and it's not looking very good for the rational expectations hypothesis. But we've persuaded a lot of people in central banks and outside them that we can control inflation through this mechanism, and that's going to be hugely damaging. We're also, to my mind, living in a very odd moment in economic history. We've had 3 or 4 speculative bubbles in my lifetime. We've had the Asian debt crisis, we had the new economy bubble, we had the credit expansion and crunch in 2008. And the more recent one has been the crypto tech stocks, meme stocks related ones. That's been a bubble which has been inflating for quite a long time, gathered some, if I mix my metaphors, gathered some pace or volume in the last 2 or 3 years, and in the last month has looked at as if it has been on the point of deflating. It's the first speculative bubble which has been based on assets that essentially, perhaps since tulips, even tulips had some fundamental value, that has been based on essentially no fundamental value at all. And we've had a set of structures and theories that have justified this particular erosion. There's a lot of rethinking we need to be doing. And at least in the practical world, we will get an opportunity to do so in the next few years, I think. I hope it will have the same impact in in the academic world.